UK inflation continues to ease, but stronger data from the service sector is pushing out the timing in which markets expect rate cuts. Stay tuned to find out more. We've came a long way with UK inflation from the peak of 11% in October 2022 to its current reading announced this morning of 2.3%. This is a moderation again from March, which was 3.2%, so quite a material easing. The downward pressure which we're seeing in inflation is coming through from electricity and gas prices, which in aggregate eased 27.1% year over year. However, there's still some upward pressure which is coming through from services such as bars, such as restaurants there as well, along with motor fuels. So easing pressures in some components, but upward pressures in others. Core inflation, which strips out food and energy prices because of their seasonality and volatility, is sitting at a higher level, but that is also easing, 3.9% from the March print of 4.2%. So whilst the direction is encouraging, the market was a little bit disappointed with the level in which we saw. At a headline level, we're only 30 basis points above the 2% target of the Bank of England, but the market was expecting a reading which was much closer to 2 or even below at this point in time. So as a result of that strength in service data, what we've seen is the market push out the timing in which they expect the first interest rate cut to come, from June into the third quarter of this year. As a result, we've seen the pound, which has strengthened against the US dollar, because the difference between interest rates in the UK and the US is expected to remain closer through the course of this year. Just because interest rate timing has been pushed out, it doesn't mean that interest rates won't come down in the future. If we look 1 year out from now, the market is currently expecting interest rates to be around 0.75% lower than their current levels. So around 4.5% from 5.25%. And then 2 years out, around 1.25% lower than their current levels. So there's still scope for interest rates to be moderated, but we just need to see a bit more momentum in terms of inflationary easing. And the print follows a series of fairly constructive comments from Andrew Bailey, the Governor of the Bank of England, who has acknowledged that we are seeing some easing pressures in inflation at a time when the economy is proven to be resilient. And as a result, Andrew Bailey has been fairly constructive on the ability for interest rates to be lowered in 2024. It also follows comments from Christine Lagarde, President of the European Central Bank yesterday, who was also acknowledging inflation is coming down, the economy is proving more resilient, and as a result, interest rate cuts could be coming in the next month or two. And in the US, Waller from the Federal Reserve in the United States essentially ruling out scope for further increases from here and acknowledging that, again, if they see further softening in inflation data, rates in the United States could too come down. So constructive data in terms of inflation, slightly higher than was expected by the market. The market was pricing quite a bit in, but we do still see scope for interest rates to be lowered over the next year and 2 years ahead. Thank you very much for watching. Please stay tuned tomorrow for more updates here on Morning Markets.